Good afternoon. This is Sean Golding with Golding & Golding, here to discuss a little bit about expatriation, how to plan for it, can you avoid the status, if you have the status, ultimately things you can do to possibly minimize your exit tax or at least plan accordingly. So expatriation tax or exit tax only impacts two categories of individuals: U.S. citizens and long-term lawful permanent residents. The latter means that you're a permanent resident for 8 of the past 15 years. It doesn't include any year that you made a treaty election to be treated as a non-resident alien. In order to be considered a covered expatriate, and you fall into either one of these two categories, then you have to meet one of the three tests, not all of them, just one. So there's the net income average tax liability test, the net worth test, and the tax compliance test, which means if you have not been tax compliant for the past 5 years, then you could be considered covered. If you're covered, there are some exceptions. There's not many. There's one for minors and limited restriction for dual citizens. You have certain hoops you have to jump through. But for the most part, if you're covered, then you're covered. So ideally, the best thing you could do is to avoid the covered expatriate status. Then you can avoid this headache. So what can you do? Well, if you have all the time in the world and you have all the planning to begin with, then you plan around having the green card for 8 years, or you don't naturalize, or you make treaty elections early on. But when you're applying for your green card, for example, a lot of times it's so that you can stay in the U.S. You don't have to worry about renewing your visa. Typically, the green card only renews every 10 years. So there's that benefit, and people don't really consider the exit tax benefits, which is understandable. A lot of practitioners don't counsel their clients on that at the time because it's not a primary concern. So if the only reason why you're a covered expatriate is that you meet the, or you haven't been tax compliant for 5 years, then you go and you do offshore disclosure, you get into compliance, and then you're good, right? Then you don't have to worry about it. If it's because of the net income average tax liability test, well, then you have to look at the return filing. Let's say you're going to expatriate, your wife or your spouse or your husband is not going to expatriate, she's the breadwinner, you're not, and so when you're filing joint, the returns have a very high net income average tax liability. You don't slice it based on who earns what. So what you would do is for the subsequent few years, you file separately. You have to look at the pros and cons as to how much the exit tax might be, considering how much their income tax will increase for spouse, and then the net income average tax liability would come down and you wouldn't be covered. For the net worth test, we'll get into that in a moment. One thing to consider is some taxpayers, when they go overseas, sort of unrelated, is they go, oh, okay, I'm in a treaty country and I live here full time and it's a much lower tax jurisdiction, so I'm going to make an 8833 treaty election to be treated as a non-resident alien for tax purposes. I don't have much U.S. sourced income, so I'm only going to get taxed by the U.S. on my U.S. sourced income. The problem is if you already meet the long-term residence test, then by filing that 8833, you're actually expatriating for purposes of tax expatriation purposes, so you want to be very careful. It's a tripwire, something to keep in the back of your mind. If you are going to be a net worth individual, so that the reason why you're covered is that you meet the net worth test, then gift planning is something you may consider. The concern is the pullback rule, the 3-year pullback rule. So typically, if you're going to give gifts to spouses, it's not going to be a big deal unless the spouse is expatriating too, or you're giving the gift in the same year that you're expatriating. But there is a bit of a gray area as to whether or not there's a pullback for expatriation. And the IRS doesn't really provide specific direct guidance on it, but notice 200985, which is a notice, it's not regulation or anything like that, does provide some framework as to how the IRS wants to view determining what your net worth is or what your exit tax calculation would be on the day before you expatriate. And they use the phrase or something similar that it would be equivalent to if you had died the day before you expatriate. And so when people see that phraseology, they think, oh, okay, well, if that's the way that the IRS is doing it, then there's the concern that if you give gifts to non-spouses, for example, that it's going to be pulled back in if it was done within 3 years of expatriation. So when it comes to gift planning, that's something to consider. If you're a covered expatriate and there's really no way around it, then there's other factors you have to consider. Do you want to cash out your 401k? So 401k is generally not taxed when you expatriate. What happens is down the line, when you start getting distributions, they withhold it 30% as a non-resident alien. Now, you may think you're in a treaty country, so you can make a treaty election to reduce the withholding, but unfortunately, when you submit that initial expatriation statement 8854, you irrevocably waive the right to be able to do that. You may want to consider selling stock, depending on how it impacts your overall tax liability. If you have RSUs and RSAs, it can get more complicated, infinitely more complicated, depending on what the values are, when they're going to vest, and things like that. If you're going to sell a home, it might be better to sell the home before, because you get the primary residence exception if you're living in it, for example, and then you have to deal with FIRPTA, which is the Foreign Investment in Real Property Tax Act. It can get complicated. Again, with gift planning, you want to consider the pullback rule. And when it comes to expatriation in general, you try to plan as much as you can. If the only reason why you're going to be covered is because you didn't file your taxes for the past 5 years, or you're not tax compliant, you can consider one of the offshore disclosure programs. We have a ton of free information available on our website and our sub-websites about streamlined voluntary disclosure, delinquency procedures, things of that nature. We have a whole website dedicated to expatriation. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day. I almost started laughing hysterically when I saw you.